Right, so here we go. Okay, so first of all, who are we? So Gravita, for those of you who don't know, is a full-service firm. It's been around a year or so. It's the amalgamation of sort of three similar-sized firms and a couple of others, and we are now 400 plus people, pretty much all in one office in central London, just above Aldgate East Station. Please come along and see us if you have not done so already. It's a lovely place. I would be able to show you the view, but it sort of blurs out the screen a bit. And therefore you've got to look at my face on a wall behind me. We're growing all the time, and that's because we've got great people who work here that do all those things and many more that are on the right-hand side. We're a member of DFK International, which is how we service our clients from all over the planet and help them with all their affairs. It enables us to really help clients when to grow and expand into different jurisdictions. And for those that have decided to come to the UK for the first time, our membership with DFK is really important to us. So what do I do? Well, I'm a tax partner here at Gravita. I once upon a time was a corporate tax inspector, no longer. And I've not been so for a little while. I help clients, as I said, from all over the world navigate the UK tax system, be they individuals or companies or anything else in between. So I work with a great team of people. There's about 80 of us in the tax department, but also those within the rest of the business to help our clients and all new ones work out what their tax situations are. Right, so succession planning. Why is succession important? Well, businesses and people are two different things. People can't go on forever, sadly, and therefore at some point in their journey with their business, which they may have grown from very, very beginnings, they need to start considering what are they going to do with that business? Are they going to let it wither and go away? Is that their plan? Or do they want to do something else? Is an exit, a proper exit, a sale to a third party, one of those things that they are interested in doing, or are they worried that perhaps a sale to a third party might lose what their business was all about in the first place? Doesn't always work, sales to third parties, particularly if you're a smaller thing and you're selling into a much bigger thing. The sort of fear that your thing might get lost, the values that you're so proud of, the clients that you've looked after for many, many years might not enjoy the experience of a much larger environment. You might not like the people that you might have to sell to, therefore you are sort of against it. There's also the other side, which is that you've sort of sitting around and you're looking at your team that you've worked with for so many years, and actually perhaps they are the right people to take the business going forward. They've got great ideas and they just need a bit of steerage and a bit of support in order to get those ideas off the ground, and you're very proud of that and you want to help them do it. The big issue with most businesses is finding those people, and therefore but if you do have those people, then you can easily identify which route to take and how to navigate that change. Because if you don't have the right people in your business in order to take it going forward, any kind of internal transactions to move forward with those people is never going to work. You need to make sure that you've got a right management team going forward. Now, you may not have them in-house already. You may need to go and find others. And to do that can be quite challenging and quite difficult to do, but it's well worth exploring. So before you do any kind of exit planning, the right thing to say to yourself is, what exit do I want? Do I want an exit whereby I'm leaving the business, I'm handing it on to somebody else completely new, as an independent third party? Or am I going to work with and trust those that I've worked with for maybe many years, or maybe bring new people in to take it forward? It's really important to have those conversations, to be honest with it. We've seen many MBOs, management buyouts, fail on the basis that they haven't had those honest conversations with the go forward group. And so that's quite an important part of it. You also need to look at what your life is going to be like post deal. So for exits, sometimes that includes the deferred consideration. So you are required to hang around for a few years to help navigate the change. That doesn't always work for people. I had a client once upon a time where they sold their business to a very large multinational. It was a very good deal, but they're required to hang around for 3 years to help it transition. One of the two lasted 6 months. It can be a very difficult change for people, and so you need to understand what that looks like for you post-deal, and not just the people within your business. Be a bit selfish about it. If you're doing the MBO route and you're handing it down to the next in line, then what does your life look like after that? Are you going to be involved? Are you not going to be involved? How much involvement are you going to have if you are going to continue going forward? And how do you get remunerated and rewarded for that into the future? And then finally, what does the business look like after the deal? If it's sold to a third party, maybe it's straightforward. But if you're selling it effectively to the go forward group, how is it going to finance you going forward? Where's the money going to come from? That's quite an important part of this. And we'll touch on that a little bit later. So the challenges. So what's the roles for the post team? The cohesion and the synergy. How does it all come together? What's the price? Right? Quite an important piece. Really understanding those options, really being transparent about that with your teams. And then the lovely bit of due diligence. What do you do beforehand? So let's work backwards through this. Due diligence. Many people think you do due diligence once you've started the process. That's not really the right way around. If you're the seller, whether you're doing it to a third party or to those within your business already, you really ought to carry out some sort of red flag review of your business. Businesses are complicated beasts. Many of these businesses we're talking about around for a long, long time. It's not so much skeletons in the closet, it's the sort of known unknowns. Those little things you think, yeah, if I was going to buy a business like this, I'd be interested in how that works, why that works the way it works, and what risks that might pose to me as the buyer. So the first thing to do is to sort of do that little deep dive, red flag reviews as we call them, to identify those challenges and those risks, and then deal with them if you need to. We've worked with clients where those challenges can be very small. We've worked with those that they are not small at all. And it's navigating our way through that, because they will come up, right? They should come up. You want to make sure that whichever route you choose, that the go forward team or the buyers would have a clean entity to work with. They understand the risks and the challenges, and therefore being looked after where needed. Price. How much is your business worth? People will talk about science. They'll say there's plenty of models, and there are, how to value a business. But what it really comes down to is willing buyer, willing seller. What is the person willing to part with in order to buy your business, and what are you willing to sell it for? Now, it's very difficult to come up with that sometimes, and people have very different views as to the value of their own business. But in any strategy you have going forward, understanding that value is probably key to negotiating, because if you value it as, say, 10 and the actual value is, say, 3, then your expectation gap is probably too large in order for this to work for you. So it's very much worthwhile engaging someone to look at the business first of all, and to give you an idea of what they think that value might look like, and see if that is something that you are willing to work with going forward. Because if it isn't, then we have to look at other options and strategies for you. We've talked a little bit about the role for the post-team deal. Typically, you'll find that within the management group, there might be 2 or 3 people in that group looking to take the job that you've done all by yourself, maybe with one other up until now, and they're running going forward, but they will need some help. So it's how long and how much involvement do you want to have in that pre and post deal? Some people take the view that they do all this work beforehand, so they basically make themselves redundant in the 3 years leading up to some sort of transaction. Others say they run it all the way up to the day of transaction, and then they just come in and help and support going forward, and try not to interfere too much, but to really be that helpful friend in the room. So how do we do it? So let's ignore third-party sale. That's not what we're here to talk about. We're here to talk about MBOs, MBIs, and EOTs. Lots and lots of acronyms. Tax is full of them. In fact, everything's full of them, frankly. But tax is not helpful in this regard. So management buyouts, employee ownership trusts, and MBIs. We're not really going to talk about MBIs all that much, because an MBI is really about inward investment, right? So you take a little, you sell maybe a little bit of your business, but I'd say take a bit of money off the table, but the guys coming in are going to pour cash into the business in order to help it grow. So that's a slightly different thing. So we're not going to talk about MBIs in too much details. What we're going to focus on is the internal sale, shall we call it, the MBOs and the EOTs, how they work, what the tax outcomes will look like, and what the challenges are in relation to them, what the possible opportunities and benefits for everybody concerned that fall from both. So the easy one first, MBO. We have some diagrams. I like drawing stick men. It's the only thing I can draw. So that's why we've got lots of stick men on some slides. So what do we start with? We start with the simplest type of business, right? Whenever I talk to clients about how do you structure a business, you start with one company. The perfect answer. You never end up there. You always end up with more than one. And sometimes you end up with different sorts of vehicles altogether. But it makes it more complicated to talk like that. And we'll come to complication later. So we've got a guy, he owns Tradeco. Simple. He's got to the point in his career, in his life cycle, where he's like, I've had enough. Right? I don't want to do this anymore. I've got this great management team. They're basically running the business already. I've spoken to them. They're happy with the value, but they haven't got the money to pay for it. They haven't got the cash, right? Who does? It's very difficult to raise the money individually these days. Rates are very high. Everyone knows this. And so how do we structure the deal in order so that let's say I'm the guy, can sell my business to the management team and have it funded going forward so I get the cash that I've sold it to them for? So why do we do it? Well, step two, the management team, those three people there, they set up MBO co. Okay, call it what you want. That's what we call it here. What then happens? Number three is the MBO co enters into an arrangement with me for me to sell my shares to them in their company. Okay. Market value. Now, usually at this stage, there isn't enough cash anywhere in order to pay me in full. So one of two things will happen. Either I will have an IOU, a deferred consideration. So inside the share purchase agreement, there'll be a line paragraph, probably more than one, knowing the lawyers that get involved in these things. And it will simply say that I owe you 10, we've paid you 2, and over the course of the next 5 years, we'll pay you the other 8, based on some metrics. It may go up, may go down based on performance of Tradeco. Fine. But more commonly these days, it's covered under what's called a loan note. So I will be issued a loan note by MBO Co. That loan note will say that I am owed X amount of money. It was payable over a period of time. It may or may not have interest on that, from which I will pay tax on if I receive the interest. But that loan note might be secured against the assets of the MBO, the Tradeco or the MBO. And it gives me a bit of security, but it also has a tax benefit. The problem with deferred consideration, so the first one, is that all the tax is paid up front because you value the deferred consideration, which is usually fairly easy, and you turn around and say, well, okay, I could receive that at some point in the future. I'm going to have to therefore pay tax on it, right, before I've received the cash. Not a perfect solution. So let's say I sold it for £10 million and I got 0 up front and I sold it today. I would have ignoring BADR, I would have a £2 million tax liability to pay on the 31st of January 2026. Now, I may not have received any money by then, so that's not an ideal outcome. Okay. So how do we do it? Use that loan note. That loan note allows me to defer my gain against it. So in essence, the loan note is a security. So it's a little bit like a share. So what we say is look, we're swapping my shares in Tradeco for this loan note. They're basically the same thing, and they're for tax purposes, and therefore I can defer my tax liability until I receive the cash. And then we've got more acronyms, right? We've got NQT, a non-qualifying corporate bond, NQCB, or a qualifying corporate bond, a QCB. You want the first one, a non-qualifying corporate bond. And the reason you want the first one is because if you don't receive all of your money, the bit you don't receive reduces your gain, so you don't pay tax on it. QCBs, you can't do that. If they somehow become worth more money, you can sell them and they're exempt with the upside, but that often doesn't happen with normal SME trade sales. So you want an NQCB, non-qualifying corporate bond. You can determine the terms between both of you, and you make the claim in your tax return to defer the gain. Simple. What we then have MBO Co, Tradeco. Now, I kept it simple. I've said that Tradeco has got all the money. It's got loads of cash, can pay me my £10 million. Fantastic. So Tradeco transfers 10 million quid to MBO Co, and MBO pays me £10 million in cash. Fantastic, right? I've gone, and MBO Co now owns Tradeco, and they can move forward with their business. In the example with the loan notes, rather than cash, there's a loan note sitting there, and the cash goes from Tradeco up to MBO Co. and then out to me in repayment of my loan note over time. Okay, so it's a fairly well trodden path. So why does tax play a role? There are problems. Whenever you sell shares, right, you don't just have to think about capital gains tax, right? What you have to think about is you have to think about income tax as well in circumstances like this. Because what I'm only doing, I'm using the profits of my business in order to buy me out of that business. Now, HMRC, under what's called Section 701, are allowed to treat that payment as chargeable to income tax, basically as a distribution. Because if you think about the company, you've got Tradeco, it's got £10 million in cash, the reserves to back it up. I could have taken it out as a dividend. I could have paid myself a dividend chargeable to income tax. I chose not to, in their eyes. I chose instead to sell my business to my business and have my business pay me for it. Now, HMRC have the power in order to treat that as a disposal which is chargeable to income tax. Fortunately, the legislation is drafted in such a way which does two things. One, it says that if you are doing this for bona fide commercial purposes, the legislation won't bite. And two, allows us to write to HMRC in advance of the transaction and say, this is what we're going to do. Please confirm that you won't look to charge this to income tax. It's called statutory clearance. It is used all the time. And HMRC have 30 days to come back to you. That's what the law says. There's no penalty to them if they don't. Of course, that would be silly. But they, to be fair, they do often come back within that 30-day window. The more complicated the transaction, they may come back with questions, which can delay things slightly. But in a routine transaction like this, they will come back and say yes or no on statutory clearance. Now, if they come back and say no, which is possible, they might come back and say no because. That is very helpful, because often that allows us to look at the reasons why and tweak the plan so that it can work. So that's the first issue that we think about income tax. No one's paying income tax when you don't have to, right? But always higher rates. Well, currently the higher rates. I guess we might find out on Friday if anything changes. There are other think about capital gains tax. So if we go back to the slides, so that I can explain it looking at the slides, what we have is two transactions that can trigger a tax charge. The first one is one transaction triggers a tax charge for capital gains tax purposes, which is the trade company being sold to MBO. We want capital gains tax to apply. We want a situation where CGT is chargeable. Okay. We want to pay the low rate of tax. What we want to make sure we pay, though, isn't 20% that we pay on all of it, that we pay 10% on the first million. We want to make sure we get BADR, business asset disposal relief, which used to be called entrepreneurship relief. To do that, we need to ensure that Tradeco meets the trading conditions. Trading conditions are sort of a rule of thumb. You look at four things. You look at turnover, you look at what the business spends its money on in order to achieve its turnover, and you look at its gross assets. Now, on a sort of 80-20 principle, that's that rule of thumb, you establish which side you're on. Is more than 80% of your income, of your expenditure, and of your gross assets relates to the trade. If it is, you're almost certainly a trading company. If it isn't, then you sort of have to look at the fourth test in a bit more detail, which is sort of the in-the-round subjective analysis. If I were to look at your company, would I say it was a trading company? Okay. And if it is, then entrepreneur's relief, or BADR, as we're forced to call it these days, should apply. There are the tax system we need to think about. There's stamp duty on the shares. There's SDLT, if there's any land knocking around, of course. And there's IHT at the end of it. So let's look at stamp duty and SDLT. So stamp duty, whenever you transfer shares, with an exchange of shares, there's a possible 0.5, so 0.5% tax charge. It's unavoidable in a sale. So the MBO will pay 0.5% on the value of your shares. It's not a big story. It's a fairly small tax to pay. It's painful. It's irritating, but it is what it is. SDLT won't apply in our circumstance because we're not moving anything around. But when we look at more complicated group structures, let's say you've got a trading company and a property company, which the trade operates out of. Sometimes pre-transaction, we might try and separate the two and spin the property out of the group structure because the go-forward team can't afford and doesn't want the trading premises. that can trigger SDLT liabilities, potential capital gains tax liabilities as well. But we'll come on to a little bit of that near the end. IST, this is a you thing. You've just sold your business. So you've converted what might qualify for business property relief, i.e. the 100% tax relief against inheritance tax, into cash or a cash-like item, which doesn't attract any relief whatsoever. So if that's worth 10 million, you've gone from a zero IST liability to a £4 million liability overnight. That's something you need to think about. Now, life insurance is the silver bullet, but there's other planning opportunities that might be available to you. For example, pre-planning, put stuff in trusts, move stuff around the family, et cetera, et cetera, et cetera. There are lots of opportunities for you, and maybe we'll touch on some of those a little bit later. So that's the simple one. That's MBOs, right? Flavour of the month, employee ownership trusts, EOTs. These have been around a while, EOTs, but they sort of went under the radar. In sort of my world, it was architects that first picked up the EOT mantle and started to employ them in their businesses. But in recent years, they've gone into vogue, and we'll perhaps understand why once we've gone through what they look like. There's only one slide here to try and explain how this works. But broadly speaking, what we do is this. We work out, right, who the go-forward team is. We've done all the pre-planning, right? We've got the go-forward team. We know what the management structure is going to look like. And then we say, right, we want the business to be run for the benefit of all of its employees. And that's beyond just paying, good salaries and bonuses. We want them to have an interest in that company. So how do we do that? Now, you don't use an MBO route. An MBO route, it's just, like in my example, it's just the three managers going forward that have shares overall in that company. And going forward, they will own the equity value of that business. With an EOT, it's structured differently. If we assume that I'm the seller, I decide I'm going to sell all of my shares, and I don't have to with an EOT, but I say I sell all of my shares to the EOT, which is just a trust, just a discretionary trust, set up for a particular purpose with particular rules. I sell all my shares to the EOT. The beneficiaries of the trust will be all of the employees of the trading business, which we've called holdco here, because often it is a holdco. And the EOT, so therefore the EOT will be holding the shares on behalf of all of those beneficiaries, okay, all of the employees. I receive my cash over time, usually, and the benefit for me is that I pay absolutely no tax whatsoever. And this isn't a wheeze, this isn't a game, this isn't us trying to be clever with the legislation. That is what the legislation says with employee ownership trust. If a shareholder of a trading company or trading group sells their shares to an EOT and the whole structure qualifies as an employee ownership trust structure, then the seller pays zero capital gains tax, ever. Okay? So that is the massive benefit to me. That's the carrot to try and encourage business owners to transition the ownership of their business to an employee ownership structure. The employee ownership structure comes from the misunderstanding, really, by the government of how John Lewis works. They quite like the John Lewis model, by the way they understand it, and that's where the employee ownership trust structure comes from. So going forward, the employee ownership trust will own all of the shares in Holdco. Good. So when Holdco makes money and it pays a dividend to the EOT can then transfer the dividend out to the individual employees. The individual employees can receive £3,700 a year tax-free as bonuses. They're paying national insurance, perhaps, but they won't pay income tax. So there's quite a nice thing in there for them. Downside in an EOT structure is that the EOT structure itself can't pay out capital gains to those same beneficiaries. So if the holdco is ever sold to a third party, the EOT will receive the gain, and any benefit that's paid to the individuals will be triggered to income tax. Moreover, it's all of the employees that will benefit from the EOT. You can't just have an EOT set up for your management team. So your management team will have no equity stake in the business going forward. How do you avoid that? We'll come on to that in a minute. So to recap, an EOT is just a trust, right, with special rules. Complicated ones, lots of them, important ones that we have to follow, but it operates just like any other trust. As trustees, and they will usually be employees, and perhaps you as the seller, but that trust will run the company, or appoint directors to run the company going forward. The way in which you're paid is exactly the same way as you pay with an MBO, except that you don't put the money through an MBO company. The money goes from holdco to the EOT, to the EOT to you. Okay? There's no tax in the EOT, usually, when holdco pays the money to the EOT, as long as it's done in the right way. HMRC haven't confirmed that really yet, but it is the understanding that that's how that would work. It'd be silly if it was anything else. So the EOT gets the money, it then pays you. Okay. Now, we have the same issues, we just have more of them. We have the same issue from an income tax perspective. Again, right, the seller is selling their shares to an EOT, and they are being funded, right? Their sale price has been funded by the resources of that trading group. That could cause a problem. HMRC can say exactly the same thing. But again, it's the same legislation, and therefore we have the same clearance opportunities. We can write to HMRC and say, this is what we're doing. Please confirm that you're not going to trigger an income tax liability on me for receiving this cash. The second issue is capital gains tax, usually, but we don't have that problem because we don't pay capital gains tax, right? If it qualifies as an EOT, so that's the second element of the clearance. We have to write to HMRC in advance of the transaction and say, this is what we're doing. We're using an EOT structure. These are all the conditions, and this is how we've met them. Please confirm that you are happy that we are inside the legislation, and therefore I won't pay any tax when I sell my shares. Okay, really important, because you as a seller don't necessarily want to find out 3 years down the road that you've got a massive tax liability that you weren't prepared for. Okay, so that's the clearance on those 2 points. We then, of course, have stamp duty and stamp duty land tax. Again, that's all to do with the sale of the shares and all to do with property. So we have those complicated structures. Then we have to cope with those as well. And again, same issue with inheritance tax. I'm converting what is a potentially BPRable asset, so no inheritance tax going forward, into cash. Right. So that is an EOT. Right, opportunities. What's the differences between an MBO and an EOT? Obviously, an MBO is easier. It's much more straightforward. All you have to do as the management team is set up a new company. All you have to do is the seller sell your shares to the MBO company. All you have to do is write one clearance letter to HMRC saying, are you happy with what we're doing? Very, very straightforward. The only complexity really is loan notes. That's fairly straightforward. An EOT is much more complicated. You've got a whole new structure going forward. You have an employee ownership trust. So that's a trust with trustees. They've got their own powers that they need to exercise. You have a board of directors appointed by those trustees to run the company. It's a more complicated structure. It's had more taxes involved because of the way in which you can benefit employees going forward. And it's also subject more to change. An MBO is a well-tested, well-tried, it's been around forever structure, whereas an EOT is fairly new, and any government that comes in, be it on Friday morning or later on in time, may look to change it, adjust it slightly, or get rid of it entirely. So it's worthwhile bearing that in mind. They are also much more costly to put together than EOT. But they come with benefits, they come with options. So with an MBO, it's very difficult to get clearance if you don't sell all of your shares. If you retain 1%, that's like a sort of, I built this thing and I kind of just want to keep hold of a little bit of it, HMRC might accept that. If you try and retain 49%, they will almost always refuse it, because you're not really retiring. You're not really exiting the business. There's no real commercial thing that you're doing here. Right? Remember, you have to have a bona fide commercial purpose of doing what you're doing. It's much, much harder to get clearance under those rules because you still own 49% of the business. Yeah. Whereas with an EOT, that's how they're designed. The legislation allows you to retain 49%. You must sell 51% of the shares to the EOT. It must own 51% at least of those shares. They must control the business. So that allows you an opportunity to stay in a bit going forward. And EOT also allows you to stay in and be part of the go forward team. You are allowed, in fact, sometimes encouraged to be part of it so that you can help the management team transition into the future. Again, very different to an MBO. HMRC are very skeptical when someone says they're selling their business and retiring and yet remain part of the team. Clearly, there's an opportunity to avoid income tax by doing that, and so they will often refuse clearance. And if you don't go for clearance in advance, or things change after the fact, then HMRC will come knocking more often than not. And again, who wants to pay income tax when they don't have to? So you could have a situation with an MBO that you end up with a 40-ish% income tax liability versus a 0% tax liability with an EOT. An MBO is a bit one way, okay? And by that I mean it's the go forward team, they take it on and it's only them. They may introduce share schemes going forward, but they can't introduce the type of share scheme that's tax advantageous, because tax advantageous share schemes can only be over the holding company, which is the MBO company, which they don't really want to give any value away from. So so people know a tax advantageous scheme, it's an EMI scheme, it's the most common employee management incentives, yet more acronyms. That an option scheme works by saying, here's an option to buy some shares, Mrs. Employee, you have to pay market value when you exercise those shares. You can only exercise those shares, say, on sale of the business. Great. Okay, so there's no tax day one. Okay, when they exercise the shares, if it's an unapproved scheme, which means it doesn't have any tax benefits to it, on the date of exercise, they pay income tax on the difference between the strike price, which is the price they pay for the shares as part of the option agreement, and the price they are paid for those shares when they are exercised options. What's the difference between that and an approved scheme? Instead of paying income tax, you pay capital gains. Capital gains is better, much better under the current regime. And therefore, that's why we use those beneficial option schemes. But again, you can't use that on the MBO structure unless the MBO is happy to give away some shares in itself, because it can't keep on the trading company below. Because an EOT works different, because an EOT is a trust, it's not a company. And therefore, the thing we care about is the holdco on my diagram. So the holdco, the bit in the bottom right-hand corner, that's the thing we care about. So we say, okay, we can actually give options over shares, right, to the go-forward team. These people are going to run the business going forward. Because at the moment, we haven't really talked about how we motivate them. The EOT motivates everybody. But if you're one of the people who are going to lead this business going forward, you might be sitting there saying, hang on, I haven't got any shares in this business, right? I've just got an entitlement as a discretionary beneficiary of a trust. Great, ideal, brilliant. Right, so I'm going to put all this time, energy, and effort into something, and I've got no equity growth at all. I'm not creating my own value. So how do you do it? Well, I can use an EMI option scheme because I can put it over holdco. Doesn't cause any difficulty to the trust as long as the trust always owns more than 51% of the shares. So we have to be careful with some maths here, right? But on this employee, and I'm looking at this going, well, okay, but you've just sold, 60% of the business for £6 million, which means the rest of it's worth 4 million. It isn't, by the way, obviously, but we're not here to talk about valuations, but let's say it is for sake of argument. And you're saying I can have 10%. Well, that's 400,000. I haven't got 400,000 pounds. I haven't got 400,000 pounds. Right, where am I going to get that money from? And the beauty of what we've just done, though, is we've just looked the company on debt. So we said, okay, you owe the departing shareholder, right, £6 million. You haven't got any money on day one. So the value of that business has gone from 10 million, right, to 4 in total. And I'm talking about giving away a slither of 4 million quid. So the valuation of that share drops dramatically. I can then do something else. I can then say, well, instead of giving it over new shares issued by that company, I can give it over new shares with a different rights. I can issue what we call growth shares. Now, growth share is exactly what it says on the tin. It only entitles the holder of those shares to growth in the business, right? And growth is defined as usually in excess of the current value of that business. So if we collapse the value of that business by loading it with its liability, so we've restricted its value day one, we then say, okay, let's restrict it further by saying that these new shares that are covered under the EMI option are only over and above that value. The value of those shares is very low indeed, as long as you can agree with the revenue, maybe later in the day. And that way, me as the go forward per the management team accepts that, okay, maybe I don't get 100% of the company, but that debt will unwind over time. So by definition, right, the value of my shares will go up because we'll go through the hurdle quite quickly. But equally, I'm in this tax advantageous incentivized scheme called the EMI scheme. So when I put my exercise price in, which maybe is very little indeed, all the upside is triggered under capital gains tax rules, which is lovely. Now, this is a bit of a this is one of those types of structures and one of those types of plans, which is maybe a little bit on the edge, but it is being often used, and it's often used just with EOTs. It's used with family investment companies. It's used with lots of growing businesses to incentivize and reward people. Growth share schemes are everywhere. And we're just using it as part of an EOT structure to ensure that the management team going forward are incentivized to build and run that business, because they would also like some share of the equity value going forward as well. What other options have we got? What are possibilities? So pre-transactions reorganizations. We are talking here about very simple business structures, usually one trading company, but very few businesses, right, look like that. Many businesses get to the point where there are at least 2, if not 10 entities. They're not always in one country, and they're not always in the right place when we try and sell them. They're also not necessarily always wanted as part of the future. So, for example, you might have a structure whereby there are companies in the group, and 2 of those 5 companies are doing something slightly different to the rest of the group structure. And so the seller might turn around and say, do you know what? I want to keep those going forward. I'm not selling you that. That's my go forward plan, right? That's my life in the future. Thinking about what I want to be doing after I've sold you the rest, that's my thing. So we would say, okay, that's fine. That's fine. How do we reorganize? How do we get that out into the hands of the individual first before we carry out the transaction? We can't do it afterwards. We can only do it before. And there are many options for doing that. But usually what needs to happen first is we have to reorganize ourselves in a position where we can carry out the reorganization to get those assets out. So it becomes a slightly complicated process and can take a little bit of time, but it's well worth planning. This all comes back to those initial things that I spoke about. It's about really understanding, have you got the team going forward? What are you getting rid of? What are you selling? What do you want to retain? What do you want to do in the rest of your life, your working life at least? So let's say simple group structure, holding company and 2 trading companies, right? One is just the main business, right? Does whatever it does. And the other was a bit of a whim by me. I'm the shareholder. I've looked at it and gone, do you know what I want to do? I want to build an app, right? Completely different business to the other thing, right? And this app's going to do something clever. I'm going to make millions doing it, okay? Haven't done yet, but I still believe in it. The go forward team has absolutely no interest in my vanity project whatsoever, right? So they say, look, we're happy to buy the existing business, right? The bit that we know, the bit that we like, the bit that we understand, and think we can make some money out of, but you can keep that other thing with no interest whatsoever. And there are many ways that we can do this, right? The holding company that I currently own 100% could simply sell the trading business, right, as part of an MBO or potentially as part of an EOT. That's possibly doable to leave me where I am. The other thing I could do, right, because the holding company might have some stuff in it as well, might hold some IP maybe. That's not uncommon. The intellectual property of the main trading companies held by separate companies happens to be its holding company. That's perfectly sensible and normal. In which case, the holding company needs to go with the trading company. So how do I get this other thing out? I'm not going to pay for it. It's mine already. And we can carry out reorganizations. And there are different types, from exempted mergers through what are called Section 110 reorganizations and capital reductions. That is not part of this webinar. That will be part of another one. But they are all achievable, all without any tax consequences for anybody, as long as we go through the same or similar clearance procedures that we've already spoken about. So we can spin that business out that I want to use going forward, and leave behind the thing that the go forward team will want to take on. And then we look at the MBO stroke EOT and what is the most appropriate and attractive for everybody concerned. So that's pre-transaction reorganization. They are very common, very, very common. And actually, the end result, the MBO say, right, is often the simple bit. The complicated piece is the reorganization beforehand, making sure that everything's in the right place, so that everybody gets what they want after the transaction. And when it comes down to clearance with HMRC on this, I always take the view that it's really important that we tell HMRC the whole game. If we don't tell them everything, then it's possible HMRC might say, look, you didn't tell us everything when we told you that we were okay with it. We've now seen the whole picture. We are not happy with what you have done. So we're going to issue what are called counteraction notices, and everybody's paying income tax. And that is not a comfortable place to be. So I would always send HMRC the whole picture in advance, because I think that the response is not worth the paper it's written on unless you have. We've spoken a little bit about loan notes already. Loan notes are usable in all these transactions. With EOTs, because of the 0% tax liability, you don't really need a loan note because you can't pay tax. You won't pay tax on it anyway. But what the loan note does do, from a commercial perspective, is protect you a little bit, so that you've got some security over an asset, perhaps, if that's how you want to draft it. It also, of course, can come with interest. That's not necessarily impossible with deferred consideration, but it can come with interest. But it also protects you potentially in a situation where the EOT fails from a tax perspective later in life for whatever reason. And hopefully at that point, the loan note provisions that we spoke about earlier, where you can hold over the gain, will kick in. So, okay, so that's a little bit of a run through of MBOs, EOTs, tax consequences, and some options that we can couple up, particularly with EOTs, to make them more attractive. I'm not sure, because I don't know how to use Zoom particularly well, whether we've had any questions. But if anyone does and they want to drop it into the chat function, you're more than welcome to do so. If anyone has any questions after this and wants to reach out, then please do. It's fairly high level. There's plenty of other stuff that we can talk about inside each of these issues. I've got a question here from someone. Are there any notes for this webinar, please? No, there is a recording though, so that'll be sent out alongside a copy of the recording of the webinar. From someone else, how does the loan note offer any security to the vendor if the loan note is issued by the trust which has no assets? The trust does have assets. The trust owns the shares in the company, but ordinarily the loan note would be written in such a way so that it secures against the underlying business assets. Sometimes there's a property involved or whatever else, and that's usually how they're drafted. To be fair, in situations where the seller stays in, right, retains say 20%, which is not an uncommon number, right, in these circumstances, they've still got 20% of the shares of the company. They've still got a vote in operations. They're still usually involved at a sort of fairly significant level in helping navigate that business, and they'll have insight as to what's going on. So there's a bit of security, and also bear in mind that the go forward team usually are people that you've worked with for quite some time, right? And so you probably trust them a fair bit, and so that's how it works. Okay, I've just seen the final question, and I was going to say at the beginning of this thing, right, that there's an election on Thursday. We all know that in this country, for those of you in the UK. And the question that I'm asked every single election, every single time there's a budget, whether there's 2, 3, or 10 in a year, is what is the government going to do with capital gains tax? Is it going to go up? and I've just been asked that question. So what do I think is the UK government doing with capital gains tax? It's very difficult, isn't it? Let's assume for a second Labour are going to win. Okay, I say assume in inverted commas. They haven't mentioned that they are going to raise capital gains tax. They haven't said really that they're going to. Keir Starmer and Rachel Reeves have spoken at length on multiple occasions about trying to create wealth for people in this country. They have also said they want Labour to be seen as the party that made them richer. Do we believe them? It's entirely up to you. Personally, I think that there are elements of the capital gains tax rules which they might consider. I mean, the first one is they're definitely going to, it's on the chopping block, is carried interest. So for those in the private equity world who hold carry, it's usually in that environment, those days are numbered. The 28% rate that applies to carry, I suspect that'll be scrapped and it will be treated as income. What that might do, who knows? But I suspect that's what's going to happen. I don't think the Labour government, if it is one, is going to impose a tax charge on the sale of our homes, our first homes. I don't think they're going to do that. I also don't think that they will come after business asset disposal relief. They might restrict it further, although that seems to make it have no value whatsoever. I do think they might bring in a tiering system. That's possible. They might say, do you know what, if it gains over and above X, that you don't pay 20%, maybe pay 25, something like that, maybe. But I don't see them aligning capital gains tax with income tax. They are very different things. We already have a higher rate for property, which is based on the reduced risk. So I think that's probably what will happen, or likely to happen. Whilst I'm talking about the election, I think the other thing that's important to say is that Rachel Reeves, when asked, said that there will be a fiscal event, so a budget, within 10 weeks of the election. So my guess is 9 weeks and 6 days from tomorrow, i.e. the last Wednesday within that 10-week frame. And we may have to wait all the way until then for what might be said. Do I think whatever government comes in will crack down on EOTs? There's a consultation document that was out a couple of years back, which for all the reasons that we've all experienced from a governmental perspective over the last couple of years has not been followed up on, which was really only looking at tinkering with it. So ensuring that the trustees of the trust have to be UK resident, to tightening up on some of the rules. But actually, it was creating a level of comfort and certainty as to how they operate, as opposed to being restrictive. So my view is that they'll probably maintain it. Whether the 0% rate stays or whether they turn it into 10% or something, who knows? But nobody's spoken about it at all within their manifestos or contracts, if Nigel Farage is listening. So yeah, I don't know about EOTs. With an EOT, how does one decide the level of each employee's entitlement to the share of the trust? It's discretionary, up to trustees. In my experience, you see documents drafted that say, look, based on performance metrics, this is how you do it. Based on, whatever. I mean, it's like any kind of bonus structure. That's how that works. Does it with only a couple of employees as an EOT still work? Yeah, it does. Yeah, subject to all the rules being met. Yeah, it can be done. It's not just for big businesses. The only thing I would say about EOTs, as I said earlier, they are quite expensive, right, to set up. They're not free to run because they've got to do accounts and tax returns and some other bits and pieces. So, bear that in mind. The legals are more complicated, so they're more expensive than an MBO, and therefore we take that into account. So for sort of smallish businesses, they tend to be a little bit on the pricey side, which wipes out the capital gains tax benefit. So that's just worthwhile bearing in mind. And will we be doing anything on agricultural property relief? Well, I won't be, but I've certainly mentioned it to one of my colleagues, fellow partners, Michaela Lamb, who may wish to do something like agricultural property relief and BPR. It's sister relief, which is more often relied upon. They are things that Labour have in the past spoken about, seeing them as being very beneficial reliefs that only apply to a small group of people. And so it's possible they may be on some sort of version of a chopping block in the future. But we can all speculate about those things. So anyway, thank you so much for those questions. We don't always get many at the end of these things, so I do really appreciate it. Again, if anybody does have other questions that come to them either now or later on, then just reach out. We're always around. We're always happy to talk. It's what we do for a living, to be honest. And thank you again for turning up on a fairly drizzly Wednesday morning. Have a great day.